Is the stock market overvalued? To answer this question, we'll examine how expensive the stock market is today compared to its own history, as well as compare it to previous bubbles, such as the dot-com bubble of 2000 and the housing bubble of 2008. But before we do this, it's important to remember that when we talk about the stock market being overvalued, we're actually talking about the value of a basket of stocks, such as an index. When it comes to individual stocks, they can always be over or undervalued. But the same cannot be said about the entire market at a given time. So how do we actually value the entire stock market? A simple and popular method is to look at the price-to-earnings ratio, or PE for short. The PE ratio is calculated by dividing the price of the index by its earnings. Today, the S&P 500 is trading at a PE ratio of 29.54. This means that for every dollar of earnings, investors are willing to pay $29 for the index. Now, while this might seem very expensive, it is not unusual for the S&P 500 to trade at a high PE ratio. In fact, its average PE ratio since 1950 is 22. That means today the S&P 500 is trading at a PE ratio above its historical average, but it is also traded at much higher levels. For example, at the peak of the dot-com bubble in 2000, the S&P 500 traded at a PE ratio of 40. Another commonly used valuation metric is the CAPE ratio, also known as the Shiller PE ratio. It is similar to the PE ratio, except it uses 10 years of earnings instead of just the most recent year. The idea is that it smooths out the PE ratio by taking into account more data. Today, the Shiller PE ratio for the S&P 500 stands at 37.24. Again, this seems quite expensive until we look at its history. The average Shiller PE ratio since 1950 is 16.83, so today, the market is trading at a much higher level than its long-term average. Another valuation metric is the price-to-book ratio. It is calculated by dividing the market value of the index by its book value. The book value is calculated by adding up all the assets of all the companies in the index and subtracting all their liabilities. The price-to-book ratio for the S&P 500, the Dow Jones, and the Nasdaq are all above 4, which is quite high compared to their respective historical averages. Now, let's look at the market cap to GDP ratio, also known as the Buffet indicator. It is calculated by dividing the total market cap of the stock market by the country's GDP. This ratio is often used as a measure of market valuation because it takes into account both the size of the economy and the size of the stock market. The current market cap to GDP ratio for the U.S. is around 1.73. This is quite high compared to its historical average of around 0.8. Next, it is important to look at the valuations of different sectors. Some sectors are more expensive than others, but what is considered expensive is relative. For example, healthcare stocks have a sector PE ratio of 40, which is quite high compared to its historical average of 25. However, healthcare stocks have never traded at such a high level. On the other hand, the energy sector is trading at a PE ratio of just 8.4, which is below its historical average of 13.7. In conclusion, there are many ways to value the stock market, and each method paints a slightly different picture. Some metrics, such as the PE ratio and the price-to-book ratio, suggest that the market is overvalued. However, other metrics, such as the market cap to GDP ratio and the forward PE ratio, suggest that the market is fairly valued. If we take a look at the valuations of different sectors, we see that some sectors, such as healthcare and technology, are overvalued, while other sectors, such as energy and materials, are undervalued. Overall, I believe that the market is fairly valued, but there are definitely some pockets of value in some areas that could see some downside risk. However, it's important to remember that valuations are only one piece of the puzzle when it comes to investing. Other factors, such as interest rates, inflation, and earnings growth expectations, also play a big role. If you want to learn more about these factors and how they impact the stock market, stay tuned for more videos. Thank you for watching, and until next time, happy investing. This explanation is for educational and informational purposes only and is not financial advice. Please consult with a qualified financial advisor before making any investment decisions.